Taking an interest in foreclosure. While just about everywhere in the United States the real estate market has come back robust and healthy and most people can count on their house selling after a short period on the market, there are some states whose residents are facing foreclosure in record numbers. Ohio, Georgia, Texas and Florida are reeling from recent economic havoc created by their area's industrial demise and the subsequent concentration on the service industry with its less plentiful and poorer paying jobs. Benefits for these service industry jobs are not nearly as good as those in the prior industrial industry, and in some cases they don't exist at all. The Mid-Atlantic states have been suffering from this loss of manufacturing jobs and firms for decades now, and foreclosure and devaluation of homes has become commonplace. Foreclosure might have been staved off in many of these situations, however, had the homeowners not been the victims of some less than reputable lending plans and firms, with ill-advised financing options such as interest-only loans that left these borrowers with little home equity when they needed to refinance or secure a second loan to save their home from foreclosure. The interest-only loans left them with little or no equity, which meant no collateral for the loan. Their homes fell into foreclosure as a result. An interest-only mortgage loan is one in which the monthly payment is exactly the amount of the interest accrued so far on the loan and doesn't touch the principal. This interest-only feature only lasts for about the first 5 to 10 years of that loan, and while borrowers have the right to overpay at any point, their overpayment only goes to future interest payments, again not the principal. What this means is that for the years of the interest-only option the borrower isn't paying off her or his loan. A $100,000 mortgage in 2000, with an interest-only option for 10 years, will still have a balance of $100,000 in the year 2010. Were the borrower to run into difficulty making these payments and find the threat of foreclosure hanging over their head, they could be in serious risk of foreclosure. Let's assume, for example, that the house's market value in 2010 was $120,000. Since literally none of the borrowed $100,000 had been paid off, the equity in the home would be at a mere $20,000. If, however, the mortgage payment made each month to the borrower included $200 towards the principal, at the end of the 10-year period the borrower would have another $24,000. Actually, the equity would be much greater because as the principal was paid down, the interest on the balance would decrease and the same payment would pay more of the principal and less of the interest. This additional equity might save a home from foreclosure if the borrower were to get sick, lose a spouse, lose a job, or otherwise get into financial trouble that made payments late or missed. The general rule of thumb is that interest-only loans should not be considered unless you know for a fact that your earning power 5 to 10 months down the road will greatly increase and your outstanding bills will decrease. Then the risk of paying a little bit now and a lot later isn't as great. You won't be risking foreclosure.